Well, thanks very much, David, for the introduction. I'll be using some slides today, and we'll go quite quickly through the presentation. So I'm not sure if my slides can be on the screen, please. Okay, they're on the screen there. Would be useful to maybe see them myself as well. Can I have it on the laptop here as well? Anyway, I have four different sections in my presentation today. As David said, it's going to be a global story, but it's really going to be also about Asia in the global context of what we see happening globally. And of course, the Asian story is very different. You all know that. So we will go through the slides now. If we can go to the next slide. Do I have a clicker to do this, or? Here we go. Having some technical problems with the slides. The first section is about global stock, and the story, here it is. So let's look at the story. It's about Asia moving up the global rankings as far as the stock numbers as well as volumes. We're going to take a look at debt, and of course the debt picture for Asia Pacific is very, very different from the rest of the world, and we'll talk a little bit about that. We look at volumes of transactions, which is probably very near and dear to your hearts as it is to ours. And then we'll look at the downside scenario, the scary things that are coming from outside of Asia your way, maybe. So this is the story I have. I've got 15 minutes to do this, so let's get started. The stock numbers that we have arrived at over many years, looking at the different regions, you can see that stock growth in Asia Pacific last year was the strongest of any region, 13% increase. To add to global growth of about 7%. Europe actually came in as surprisingly strong as well. But if you look at it a bit closer and you look at the exchange rates based on stable fixed exchange rates, the numbers look much more modest. If we then look across Asia, the story becomes very interesting because the Asian story last year was about Chinese growth. This year, it really is about much broader growth. It is about growth outside of China as well as inside. And so you can see that Japan and New Zealand are the odd ones out with negative growth for different regions that are very obvious. But you can see that there are other countries, other markets across Asia Pacific that have grown more rapid than China. And that is a very good news for the region as a whole. If we then look at the breakup of that growth between debt and equity, the interesting thing that happened last year is clearly that we have seen equity growth much quicker than the debt growth, and debt growth being positive in all the regions except for North America. So different again from 2010, where the debt was still negative growth in North America and Europe, but for Asia, actually, debt growth was still outstripping equity. Of course, what that means for the loan-to-value ratios, if we take the total debt versus the total stock, we're coming up with this sort of loan-to-value ratio of the whole sector in aggregate. You can see that deleveraging started in the rest of the world already in 2009, and in 2011 we see Asia Pacific joining that global trend. The leverage ratios are coming down. Of course, it's a much more moderate level to begin with than in most of the Western markets. And we'll come back to that in a minute, because this is actually one of the key reasons that we are more optimistic about the Asian markets than any of the other regions. So if we look a little bit closer into the debt outlook for Asia Pacific, we can see a number of things. Let's look at the global picture first, just to contrast it later on. This is coming out of our lender survey. This is a survey of global lenders across the board. And you can see that their expectations for growing their new lending is actually down from last year's survey. And so we see a near tripling of lenders that see a reduction in their lending activity. Of course, the terms of that lending is also much less attractive for borrowers. So the tightening of these lending terms is also increased more than sixfold. We see an increase in the responses for people that are seeing a tightening of conditions in this year's survey versus last year's survey. And most of them are not expecting this to improve next year. For 2013, if you look at the right-hand side of the chart, you can see that still almost 2/3 of respondents are seeing the same or even tighter conditions next year as well. So it's become a lot more difficult and expensive to borrow money. And of course, that's on a global basis. If we now look at the regional picture, the picture is actually quite a lot different. And so this is looking at again, the 2011 and 12 survey results, and now by region. And you can see that actually for Asia Pacific, the survey results are showing that 33%, which is a ratio of 1 to 3, of lenders are seeing lending actually increase in the region, as where, of course, the rest of the world, it's the reverse of that. More lenders are seeing a decline, as we saw before. So this means that the outlook for lending in Asia Pacific with existing lenders in the market is much more positive, and that sets you up for a much more positive outlook. If we then look at the survey of investors, these are people that borrow money, we can also see that their expectations are also very different and, in fact, consistent with what we saw from the lenders. That means that for the Asia Pacific investors, they are more than half of them are expecting the bank lenders to still do more lending than they did last year, which of course in North America and Europe that picture is the complete reverse, with 85% in Europe expecting banks to do less lending. So it's pretty stark contrast here. If we then move along to the investment volumes, and this is of course the proof of money put to work in our investment markets, we can see some interesting trends across the Asia Pacific region. And this is looking at all transactions across the region, and you can see that the Chinese volumes are quite strong. Come down a little bit from the record in 2010, but not actually by a great deal at all. And you can see the rest of the markets falling into place. Certainly compared to the Western markets, we know that Asia is still recording very close to record levels, as where most of the Western markets are not anywhere close to that. Now, these statistics actually include land sales in China, which are a big component of turnover in the Chinese market. If we exclude them, the picture becomes a little bit different. And so here what we've done is we've shown you the same volumes, but now on a percentage breakout. And here you can see that slowly but surely we're starting to see the dominance of domestic investors in Asia reduce. Now we're still talking about a decline from 88% to 8%, so it's still pretty modest, but we are seeing more investors from outside of their home countries being active in the investment markets. And that is in particular coming from intra-regional investors. So these are investors from Asia investing in the region but outside of their home market. Okay, so this is that increase from 9 to 16% that we saw last year, a near doubling of that last year, which is encouraging. But at the same time, we also see that interregional investment, which is non-Asian investors buying into Asian markets, that actually halved as a percentage of total volumes from 8 to 4%. So those two are, of course, partially offsetting each other. But in general, we are seeing a return of international investment activity in the Asia-Pacific markets. Now, of course, then we can slice and dice this data a little bit more and look at the intra-regional transaction flows. And here we saw a little bit of a surprise. We were a bit surprised ourselves by the dominance of the Singaporean investors. And so you should all feel very good if you are part of this. The majority of investment activity in Hong Kong, in Australia, certainly also very large share in Japan and China as well. So Singaporean investors being very active throughout the region, and that is partially because you're a hub of regional investment management activity here in town. And you can see the destinations of that capital as well, with both Hong Kong and China leading the way, but Australia and Japan following very close behind. Then, of course, if we finish the story and split up that small sliver of interregional transactions, again, you see the numbers are quite modest still. We're looking at probably altogether about 3-4 billion. Still nothing to sneeze at, but this is a very small percentage of the overall volumes. And the surprising thing here is that, of course, Australia has been able to attract most of that non-Asian investment capital, which followed by Singapore and Hong Kong, which you would expect to attract that capital as they are very liquid markets. Now, let's have a closer look at the downside scenario. We get a lot of questions from our clients. How bad is it going to get, and how does it impact my markets? And this, of course, is coming not just out of turbulence still in the bond markets, where bond yields, in particular in Europe, are still widening out for some of the crisis-struck countries, but also volatility across the board. And so the way to deal with that is to look at different scenarios of economic growth. And this is exactly what we've done. And so here we show you the underlying GDP forecasts for the different scenarios. So just to explain, the base case is a continued recovery globally. It's slowing down, but it's a recovery nonetheless. In the downside scenario, we assume that 5 countries leave the Eurozone in 2012. Of course, we're already halfway into 2012, so the probability of this actually happening is becoming less and less. However, the 5 countries are of course, Greece, Portugal, Spain, Italy, and Ireland. And if those 5 leave, then the remaining Eurozone countries will have very close to zero GDP growth. The impact on Asia Pacific and US GDP growth is much more modest. We're a little bit puzzled by the Singapore results, because it's actually showing slightly stronger GDP growth than in the base case, but this is coming from Oxford Economics, and it's over a 5-year term. So perhaps Singapore is able to have a stronger rebound than the rest of the region. If we then look at what this means for stock growth, then we need to highlight the fact that in Asia Pacific, stock growth in particular has a strong momentum behind it from all the buildings that are currently in the development pipeline already. And so this is this difference between capital growth, which is existing buildings increasing their value, versus stock growth, which is just an addition to stock from new buildings being delivered to the market. And you can see that for Asia Pacific, that black bit in the bars is much, much higher, which means that it's just all the new buildings that are expected to come out into the market. And in fact, the capital growth that we're assuming in our forecast, and this is the base case forecast, is actually quite modest. In fact, if you look at the capital growth forecast across the different regions, you see actually more modest growth for Asia than for some of the other regions. But then what we need to consider is what is the impact on invested stock in the downside scenario. And this is showing both the base case as well as the downside. So if I just focus on the shock value of this graph, you can see that for Europe, there's a 15% reduction across the markets that we cover here, which is 200 markets globally, 100 in Europe. And so across those 100 markets in Europe, we are seeing a 15% decline in capital values in 2012 if this scenario materializes. In 2013, there's still a bit of that downside left, as of course Europe is a big place, is at 100 markets, and the impact will be sort of spread out over time. The thing that did actually surprise us the most was actually that the impact for Asia Pacific markets was also quite significant, a near 5% decline if the Eurozone breaks up. This was actually much more severe than we had expected. And so, we've been talking with our clients about this as well. But you can see, of course, it's a timing issue. If we see export growth dry up in some of the key markets, especially markets that have had a strong development pipeline of new supply coming out, if that demand is immediately hit, but the supply pipeline is still coming out, as I said before, of course that will have a big impact on market rents, especially in the short term. Over time, that impact is reduced as domestic growth is picked up, as policy responses kick in, and you can see how the downside scenario impact in Asia Pacific is much reduced in that second year. And so if we then conclude that this is all a matter of timing, then we can of course expand the time horizon of our forecast. And the forecast on a 5-year horizon are showing very strong resilience. So this is cumulative change over that 5-year period, and there's only one sector that we think is not resilient, that does not show capital values ahead of where they are today, and that is European logistics. So we're particularly negative on that sector. We don't think it would be a very good defensive play at the moment. This is assuming that you have to invest money today and that you hold for 5 years. The point for Asia Pacific is of course that compared to most of the other regions, that the resilience is much stronger, the momentum of growth is much stronger, and if you're being questioned by either your investors or your risk colleagues about the reasons behind some of the things you want to do right now, you can point to this and say, listen, even if the worst were to happen, I'm very unlikely to have a capital value below from where I start today. And so that is, those are some of our main points. So if I just sum up, it means that Asia Pacific is the second largest region now globally in stock, and that is the growth expanding beyond China, but we're now, as Asia Pacific, we are now a bigger market than North America, and that is quite an achievement. As I said, also the deleveraging trend is starting now in Asia Pacific, not because debt is going down, but because equity recovery is stronger than the growth on the debt side. And the outlook on the debt side is still quite positive because of the lack of legacy issues here in the region. And we saw from the transaction volume slide that the international diversification strategy of investors is starting to trigger more intra-regional activity, more Asian investors looking outside of their home markets, and that is of course also an encouraging sign for a market that's coming out of the bottom. And then in the downside scenario, as I just highlighted, there's strong resilience and doesn't seem to be a need for any workout as we see in some of the Western markets. So that's my presentation for today.